Thank you guys for being here with us today. Access to basic financial services for entrepreneurs can often be a make it or break it moment, especially early in the days. Greg, can you give me an overview of the basic financing options that an entrepreneur has today?
Yeah. So when you think about entrepreneurs, that's a broad question because you got the true seed stage entrepreneurs, and then you have when they raise that Series A round, Series B round, and Series C round, right? And so when you're just starting out, when you're a seed company, you typically are going to first finance yourself with equity of some type, right? That's where that needs to come from.
And that's venture capital?
May or may not be venture capital. If it's a seed round, it typically would be friends and family and other ways that people come up with capitalization, and to include more venture capitalists are doing seed financing than ever. So it starts there. And then trying to figure out for us, or I'm sure Henrique as well, like how do you lend some money? And it's typically credit cards at that early stage. And then once they receive that Series A financing, then it's venture debt and a lot of different products and services. But it starts out at that early stage more from an equity raising perspective, and then it gets into a little bit of credit and kind of moving their way up.
Got it. And credit, it's tough to get, especially in the early days. Henrique, you moved from Brazil, and you had a little bit of trouble with the traditional banks. Can you tell me a little bit about that?
Yeah. So moving. I came from Brazil. I started a payments business down in Brazil, and then moved here in September 2016. And when I got here, I had sold the company down there, but I was what's called a thin file, right, or no file.
What does that mean?
So it means that if you looked up my social security number, you couldn't find anything.
Because you didn't have any credit in the
Yeah, because the way your social security number actually gets inputted into everything is by having credit, but then that's kind of like a chicken and egg problem. So for us, we had the problems like we couldn't get a personal credit card, and then when we started a company, we had raised millions of dollars, and we still couldn't get a card because we would say, hey, you need to personally guarantee this card, and we couldn't personally guarantee because we didn't have FICO. So it was kind of like this chicken and egg problem, and we saw that we were in YC, the accelerator, and we saw that a lot of our other companies there also had similar problems, and that kind of inspired us to start Brex.
And can you briefly explain what Brex does?
So we do corporate credit cards for now startups, e-commerce, and life sciences companies with now no personal guarantee, high limits, and can go from 0 to a working card in 5 minutes.
That's interesting. So how do you both assess a company before deciding to give it credit? What are the factors you use?
Yeah, so there's several things, right? So one is, you got to look at how they've been capitalized, if at all, right? So they've raised some seed financing of some type. That helps. That's probably when you don't have revenue and you truly are getting started. That's probably one of the only ways that you can assess. You do look at the team itself, but it starts with just kind of how they're capitalized at the beginning.
So you ask for revenue, and you look at the people who have backed the company.
Well, it may not be. So this is
pre-revenue.
Pre-revenue, and it could be pre-venture capital, right? So it could be, have they raised a seed round from somebody, right? It may or may not be venture capitalists. If it's venture capitalists, it obviously helps. But if it's other ways, to raise money in other ways, we'll take a look at that as well.
And Henrique?
I think the fundamental insight, is, for SCB and for us is that there's some diligence process that goes into someone raising money, right? There's some diligence process that you as an entrepreneur, you need to go there and you have to pitch this guy or these gals or this set of people, and they, need to decide to give you money, right? And that's like a pretty intense thing that you have to go through. So, if you were gonna steal money, you might as well steal your venture capitalist money. You don't necessarily.
Thank you. Yeah, I was gonna say we serve as a really good credit check system, as it turns out. Yeah.
Exactly, but that's kind of true. It's like the risk is much reduced because they go through that process, which is actually pretty rigorous. And the thing about startups is that they only die for one single reason. They die because they run out of cash.
Is it though?
Yeah. I mean, at the end of the day, if you have cash, you can have no revenue, you can have, be up for 10 years. You're still there paying employees, et cetera, right? And if you decide to shut down, and you have a lot of cash, you usually pay your people. So, especially in the early stage, it changes when you have complex debt structures in the future, and you get really big. But in the early stage, most startups, you raise money, you spend that money, either you raise more money or you die, right? So that's kind of like the fundamental insight of how the industry works that helps all the underwriting.
And what is the minimum that a startup needs to have raised for you guys to issue it a credit card?
For Brex, is around 100K.
100K?
Yeah.
Okay. Dana, how do you feel?
I know everybody's.
As the venture investor, how do you feel kind of being the credit check for some of these?
Yeah, I mean, we're accustomed to taking risk, and that's fundamentally our business. I mean, as clearly as Silicon Valley Bank. I mean, as far as banks go, but we've always looked at really like what is it? I mean, it's almost as much about psychology and determination and grit and a lot of the things that you're talking about, Henrique, that we look for in entrepreneurs when we're backing them. At the seed stage, in particular, when you're sort of looking at something that is pre-launch or pre-revenue, and so we're very accustomed to that. I think the interesting thing is that folks. Banks, credit cards do look to us as effectively sort of doing that diligence oftentimes and sort of make those determinations. But I think increasingly everybody has access to great volumes of data that can really, I think, provide probably even better indication. And so I mean that's something I'm kind of curious as to how you guys are thinking more about that. I mean I think you guys traditionally have based a lot of decisions on relationships and on sort of past history with folks, but as you have greater volumes of data, how does that change?
Yeah, it's both, right? So it starts out when we were talking about it's that how much money has been raised before. That's what you mainly look at before there's any revenue. Once they start having revenue, you can start looking at metrics and you can start to lend to those metrics. And that is really helpful. So we don't just look at capitalization. We clearly look at Greycroft is in there. That's a very important, check the box that, hey, there's a great venture capitalist involved. But that's just one piece of the puzzle, right? I think it's also important as much of it is a important check that you're involved or other venture capitalists are involved, right? We look at other factors, and as you know, I mean, startups don't always work out, and there is no guarantee, right? The venture capitalists aren't guaranteeing the debt. Individuals also aren't guaranteeing the debt, so the principals of the firms. And so we do have to look at the business overall and what the prospects are for success. And so all that comes into consideration as companies scale, and then we layer on different products and services as they get bigger and bigger.
Yeah, and it's important to note that even really well-funded startups have trouble doing business with banks because it's very, very high risk. So what happens when a startup that you decided to back goes south and you realize you have, a fire festival on your hands?
Yeah, we don't call it a fire festival, but it happens, right? Companies don't always work out. And
right.
So what our approach has always been that we're working with the investors, we're working with the management teams to what we call as a soft landing, right? How do you end up in a situation where you can come up with the best outcome possible in a difficult situation, right? And that means trying to figure out, okay, can the business, does it have intellectual property? Is there something there that can be sold to another partner who values that in some way? And so we work with kind of the other constituents to make sure that we're doing as much as we can. A lot of it, the reason we think that way is because entrepreneurs, they're not done. With that company, even if it doesn't work out, they're going on to the next company, right? If you're working with a venture capitalist, they're not done just back in that one company. They're going to work with other companies. And so it's a very long-term relationship that we look at both with the entrepreneur and with the venture capitalist. And so we try not to overreact in situations when it becomes, as you described it, a fire sale or however that was described.
Can you just briefly give me a very quick example of a company that completely imploded and made you change your strategy in some way? Because you've been around for decades.
Yeah.
And you've seen this.
Yeah, it's hard to give a specific example, right? Because people don't like talking about the negative situations, but again, it happens on a regular basis where a company, and it's not just because they run out of cash, it's because their business model doesn't work, right? And they sit back and go, we can't generate more revenue. And so from our standpoint, again, we're sitting down and asking the right questions with the investors, with the company, like, okay, what is your plan B? Plan A isn't working. How are you going to pivot the business? Is it going to be recapitalized? Or if it's not, how are you planning to take that to the next step, right? Again, we think about it as a plan B. but it happens on a regular basis for sure.
Got it. And Henrique, how do you assess risk? Because I know you have kind of a dynamic algorithm situation.
Yeah, our fundamental belief on credit cards in general, and I'm not saying this can be applied to any kind of lending product, but it is that the way that credit cards have traditionally existed so far has been, it's kind of like a private market investment versus a public market investment. That's the example I like to give, because you give someone the limit once, and then a lot of banks, they don't look at it again until either the company's defaulting or they call them or something's happening. And what we created with Brex is that this dynamic system that we're reevaluating the credit every day based on real-time input that we get. So for startups, that input is mainly cash.
So you ask for their bank statements?
We ask for real-time access to their bank accounts to get their balances. The deal is you give us your data, and in exchange, I'll give you a higher limit, no personal guarantee, and I'll underwrite you very fast. So that's kind of how but the limit can change every day. So if one day you have $5 million, the other day you have $1 million, you burn through 75% of your money in a month.
So you're looking at the burn rate,
yes,
the cash burn, and you're deciding, your algorithms are deciding on the spot.
Exactly. So that, will change. But because we have so much less risk, because of this dynamic limit, it allows us to be very aggressive, giving usually very high limits, very fast with no personal guarantee. And I know with startups, I think, is not that hard of a job because cash is like a pretty, secure thing. I'm very surprised that the team got really great results was in, for example, e-commerce companies that instead of looking at cash, which is the driver for most e-commerce companies, we actually look real time in their revenue, their gross margins, their advertising performance, like all these other things that we can ingest real time and also keep making these decisions.
I see.
Well, I think that's one of the sort of interesting things. I mean, right now we're obviously living in a time where access to capital for startups, sophisticated entrepreneurs is very, very inexpensive. And so I think everybody in the capital structure is having to find ways to provide more value. I mean, I think that's why, Brex exists. I mean, I think that's why there are all of these opportunities, and there are companies sort of finding ways to provide values to specific verticals, whether it's SaaS companies or e-commerce companies, because they actually have different needs than just sort of a blanket loan. And so, I think it's a really interesting time because all of a sudden entrepreneurs, are becoming much more sophisticated in general about their capital structure. And I think, everybody will have to be, all kinds of capital providers will have to be more competitive in providing, greater value in all kinds of ways.
Yeah, I think Piggy is just all of that. I think one thing, I imagine one of the reasons SEB worked for so long is that you guys actually understood how startups worked. And banks have a lot of times have this thing where they pull SMBs into this gigantic category called SMBs.
Right.
But the reality is that startups are very different than restaurants. They're very different than hotels, It's completely different businesses. And if you try to do the same thing for everybody, you get unoptimal results.
And even within the innovation space, to Dana's point, I go back, I think about 10, 15 years ago, you would just do, for us, it was working capital financing accounts receivable. And now it's, SaaS lending, it's recurring revenue lending, it's mezzanine lending, it's convertible debt lending. It is a very, very broad product set specifically tailored to the industries that those companies are in. And they are very different, to Henrique's point, and you have to understand that difference, for sure.
And I'm going to open it up for questions in a minute, so if you have any, please think about them. One more question, though. I think like you said, access to capital is, right now, it's very easy to raise capital, whether it's crowdfunding or SoftBank or whatever it is. But how do you guys think about, what if the market turns very suddenly? I mean, you've been around for 2 or 3 years, you've been around for decades, but how do you think about that? I mean, what will happen if startups just start failing, and what happens?
Well, we can look back to 2000 to see. I mean, that is when really fundamentally people start to get scrappy again, and I think that's where you see the best entrepreneurs succeed, and that's why I think a lot of the huge companies today sort of came from that time, because people figure out how to do more with less. and that's when they do things like, you know, try to get as much, you know, highest limit on their credit cards as possible, and when they try to, you know, do all of those things because you have to. And so I think.
And what are some of the implications for a business like yours, for example?
So, you know, every time I talk to people who have been in the industry for a long time, you know, usually recession and regulation are the two main topics of conversation. And the reality that we found out after a lot of these conversations is like each of these crises were so different from the other one that, you know, saying that we know how we're going to look at a next crisis is just naive, right?
But is it something you're prepared for?
Well, we can do a few things to be prepared for. First one is raising a lot of money. So, you know, we're trying to get that part covered.
And how much total capital have you raised?
$320 million. You know, and setting that aside for a rainy day, because worst case scenario, you at least, you know, you can have money to pay back everyone. The second thing you can do is actually, you know, model that in your risk models. Like, okay, in this downside scenario, if, you know, this, and this happens, how would I react? And, you know, and have controls and covenants and things like that within your business that you can set maximum risk parameters. Like, up to this, I'm willing. Otherwise, I'm breaching what I think, you know, would be responsible for me to do. And you need to have experienced people in your team that came from someone who saw this from, you know, a crisis perspective and a recession perspective to help you determine what those parameters are. That's the second thing. But the third thing, you know, and I think this is more unique to Brex, is, you know, recession is not like you wake up this day and everything was down, right? Like, it's something that kind of comes for a long time, and then one day it's all over the news. Because we're monitoring these things every day, you know, we are readjusting our exposure every single day. When it happens, we believe, and, you know, it hasn't happened, so it's conjecture, right? But we believe that our exposure was way less than already everybody else because we're re-underwriting every day, right? So, you know, if startups stop getting funded or they reduce the amount of cash, our limits go down.
Right. And how much capital are you reserving for a rainy day?
Well, as we grow, it increases, right? It's more a percentage than a total amount.
What's the percentage?
I don't know on the top of my head right now.
Any questions, Alan?
So Sean Tully, who is here someplace, I don't know if he's sitting in the audience right now, but Sean Tully did a fascinating analysis for Fortune where he looked at the burn rate of this new crop of unicorns getting ready to go public. And it was way out of line with any historical experience. Contrary to popular perception, it's not what Amazon did. Amazon didn't have anywhere near the kind of negative cash flow that some of these companies have. So my question, I know that that's a higher level than we're talking about here, but my question for you is, are you analyzing that differently today than maybe you did 10 years ago? Is blitz scaling a thing, you know, and that you have to tolerate burn rates and negative cash flow for much longer periods of time than maybe you would have a decade ago?
Yeah, I think one of the things that companies are looking at doing is saying the opportunities they're going after, I would argue, are much, much bigger than they have been historically. And so when you are going after something really, really big, you need to raise a lot of capital. I mean, you guys have raised $300 million. There's a lot of examples of companies raising hundreds and hundreds of millions of dollars and even billions of dollars, right? And so they're looking at scaling as quickly as possible, and it takes a lot of capital to do that, and you have to burn a lot to get there. So we've seen that. I think it is a different paradigm, but I actually think they're also, with their investors and the support they have, many of them are going to be successful. The valuation may end up being less than they originally thought, but the business model for many of them is going to be a unique new business model, and it's just a different way to fund these companies, and they're being so much better well-funded than they were historically. Obviously, that allows them to have such a higher burn rate. So I do think it is a different paradigm than we've seen historically.
Well, it is. I mean, the opportunity is global. I mean, and I think that's sort of, you know, fast, right? It's sort of, I mean, it used to take a lot of time for a company to truly become global. I mean, arguably, you know, Amazon still isn't, you know, really in every market, right? So I think it is a different time. And, you know, if you look at what, you know, Uber said this morning about really wanting to dominate all transportation. I mean, it's no long, you know, it's sort of really, of course, but so, you know, I think that is the way that companies are thinking about things, and it lends to a higher burn rate. I mean, I think the obvious sort of question or point is not everybody's going to win. So there's going to be a lot. I mean, a lot of money that will be lost.
Yeah, I think there's also a counter-positioning argument to be made, which is because these companies are private, they can be unprofitable and the markets will still reward them. Therefore, they can be more aggressive in growth versus the incumbents. If they, their profitability drops to a certain point, their stock goes crazy. So there is this kind of private market versus public market arbitrage that private companies are taking, which I think, I don't know if it's right or wrong, but it's a reality that a lot of growth companies are taking advantage of.
I think the question will be is if the capital formation, ability to raise capital starts to slow down, what will companies do? And do they really have an ability to scale back the business to get closer to cash flow break even, right? Some companies you can look at and say that's likely to happen. There's other ones that you look at and you say, I hope they have a lot of other plan B, C, D, because that may not be the right approach. But I think what Henrique said is right, and I appreciate that, which is they're thinking about it and saying, I need to have other plans in place. I need to have triggers. If this happens, this is what we're going to do. This is how we're going to pivot. And I think more and more companies need to make sure they have that, even when they do have a lot of capitalization and a lot of cash in their balance sheet right now.
Anybody else?
I have a question.
Yeah.
Are you guys, seeing anything in any of your data now that would indicate
Like
anything?
market changes?
Yeah.
We're
That you want to talk about?
No, I'm happy to answer. Go ahead.
Yeah, no, we're only around now, launched for a year and live for like a year and a half. So for us, it's still all-time highs, but
Right.
we definitely have a lot more insight.
Yeah, I mean, from a credit perspective, right, there's a lot of money out there. One of the other points I was going to make on that is that if you look at the number of companies that are getting money, right, it's actually lower now than it was in 2015. 2015 was kind of the high water mark. And since that time period, you've seen more capital being invested, right, now up to $130 billion last year domestically, and about 30% fewer companies. So the market is going after what they would argue are the best companies, and more money is going after them, right? So if you look at that dynamic and the amount of capital, right now today, the credit risk isn't that high. The question will be, what does it look like a year from now or 18 months from now if capital does start to get a little more difficult, if the market gets a little more challenging. But right now, we haven't seen any cracks in the overall environment.
Got it. And just really quickly, Greg, you and I talked a little bit about this backstage, but for some of these frontier tech companies like blockchain and crypto, are you willing to work with founders like that where the risk is even higher than maybe some of the ones that have traditional VC backing?
Yeah, anything that's in the innovation space, right, is in our kind of bullseye target market. So we'll look at all those industries, right? When you start looking at crypto, the currencies themselves, there's the regulatory side that we also want to make sure that they have strong compliance characteristics, because there is higher risk from a regulatory perspective, and we want to make sure that we're on the same page with how they think about the regulatory environment. So that's another factor that you have to deal with crypto companies that you typically wouldn't have to deal with a drone company or a robotics company. So yes, everything across the innovation space is in our target market.
Got it. And Henrique, do you have any startups that you work with in the space?
So we're still pretty focused on the main traditional SaaS e-commerce life sciences for now. I think, as a startup, crypto, marijuana, all these markets are a little bit tough from a regulation perspective. So we still are trying to get our heads around it.
Got it. Great. Thank you guys so much.
Absolutely. Thanks.